Let's bring in Peter McGuire for additional perspective. He's the CEO of XM Australia, and he joins us from our Sydney studio. Peter, I want to get a bit of a sense from you about where these trade talks are going to go. You've got two sides. They're mostly positive about where the conversation is going to go. Do you share that optimism? Is it time to get significantly more risk into this market, risk on?
Well, good morning. Yes, I do share that optimism, and I think it's been very evident over the last matter of weeks. There's, dialogue from either side to try and get a deal set. We understand where the president's, where Trump is, and saying that he's not going to meet till after the 1st of March. But the general feel, I think, across the markets is that something will happen over the next matter of weeks. And I would say, by mid-March we could see some form of resolution, which in turn is going to be a very strong stimulus again to the global equity markets and probably further push up for the Chinese market and good news for everyone else.
So, Peter, what are you recommending in terms of asset allocation? You're saying you've got more risk appetite. Does that mean more emerging markets? Does that mean more China in particular?
Well, I think it's got to be more emerging markets. We're understanding what China experienced in 2018. It was savagely sold off, and it's been a very strong, last month or two as far as, rebound. Globally, we're seeing softness, as far as, the Eurozone. But if you look at the big headline numbers, the Dow's still very, very strong. Emerging markets are on a rebound phase, and I think that there's still upside there. So investors are, in a fairly good sweet spot. You've got low bond yield, but at the other side, of course, is that there's more momentum, and I think it's going to be not a bad time to be back in the market.
How do you protect to the downside here, Peter? I mean, we've seen a lot of volatility in these trade talks. So, one day it's positive, one day it's negative.
Sure.
Now, if things go off the rail at the end of the month into March, as we hit that deadline, where do you go? I mean, how do you protect?
Well, I think it's been evident what we saw. If you're saying, that September, October, November sell-off, everything was smashed to the downside from equities to crude. Gold had a very strong uptick from the start of October. It's had, very, very strong moves. We're now at $13.25. Only at that period we're at $1,200. So it's nearly put on $1.25 a day in that short run. The markets have had very strong pullbacks leading into that Christmas period, and since then they've rebounded. Crude was off the best part of 40%. Since then it's put on about 33%. So it's been a bit of a feel-good movement, and I feel as though that there's more upside. Earnings are a little weak in the States, but I think overall there's not going to be too many, as far as the Fed's concerned, rate rises this year. We might get 2, we may only get 1, and I think there's, the risk appetite's there for more momentum.
Peter, we had this data out of China which showed the record high credit in January, underscoring the Chinese stimulus efforts and how much of an impact they are having. Is there a need for further stimulus, and do you expect that to come in the form of fiscal or in the form of some of the R cuts on the monetary side?
Well, probably fiscal, but the other side, I think there's been just massive stimulus all the way through from infrastructure and really trying to get that economy back on track. They're very much under the pump. They're concerned, the trade talks in the States, their market was savagely sold off last year, and naturally, the government's got one agenda, and that is to keep that, priming of the pump, and that's been very evident over the last matter of months. Those numbers that came out in the last matter of, an hour or two have been very evident to that, and it's fairly strong to demonstrate to the market. And on the backdrop of that, you see the trade talks get some sort of resolution in the next month, and it's going to be a positive for China.
So outside of China, where are your conviction calls in a world where there is a trade resolution, and from what you've been saying, you believe that that could happen? Where do you find your top conviction calls in the Asia-Pacific, perhaps, around Japan, around Australia? I mean, is there anything in some of the more developed markets that you'd be taking up outside of the United States and Europe?
Well, I think you'd have to look at the Aussie market. That seems to be, some further upside. I think that, though it's been fairly range-bound and very choppy, some of those emerging markets are strong throughout the Asia region. I think there's more upside there in the 2019 and leading into 2020. I see some of those numbers coming out of the likes of Vietnam and Thailand. I think India's got to, shoot the ball out of the park as far as their GDP numbers and what they'll do for their forecast over the next matter of, 3 to 5 years. So there's plenty of upside in that region as well. And whilst you've got some markets hemorrhaging, and you look at the likes of the Brexits and what's happening with the euro, there are other areas of the world that are performing and outperforming very, very strongly, and that will only increase through population and demand picture.
Peter, we're going to dig deeper into some of your other views around the United States and the Fed. It's Peter McGuire. He stays with us. Peter McGuire, CEO of XM Australia, is still with us from our Sydney studio. Peter, I'm going to jump straight into the Bloomberg and pull up a GTV chart. Our clients can easily access this on their Bloomberg. A story about diverging views as to where this balance sheet runoff is going to go. A very wide band that we have between strategists with their calls. Where do you fall in this spectrum?
Well, I tell you what, I think, volatility, when you read a chart like that and you see those large divergences, everyone has an opinion. It's a hard one to say. I think, you've got so many different criteria coming into the melting pot. I'm erring on the side that you're only going to see one and maybe two this year, but I feel as though it'll probably only be one. And all of that is going to be very much heralded over the next, 3 to 4 months. What happens globally? What happens with Brexit? Where does the Eurozone go? What happens as far as trade talks with President Trump? And where is China? And all of that goes into a melting pot. And then I think the Fed are very mindful of that. Their inflation, energy costs are cheaper than what they were this time last year, and that's a good sign for the global consumer. So one rate rise.
So one more rate rise is what you predict. What's going to happen to the greenback in light of perhaps domestic strength, but also weakness in other currencies abroad? Your research note talks about the dollar being the best in an ugly bunch, the only decent house in a bad neighborhood.
Exactly right. That's the line, and that's going to be the line all this year. You look at the New Zealand dollar, you look at the Aussie dollar, we're talking about rate cuts in those two economies. You're talking where the Eurozone's going and what the overall picture there, and there's structural weakness that we know. Thinking where the US is, you've still got relatively okay earnings, nothing like 18 and those tax cuts that came in, and that really buoyed the market very strongly in 18. So that'll be a lot weaker this time, and nearly to the point they're saying, will it be an earnings recession, 2 successive quarters versus this time last year. But the other side, of course, is that US dollar, we think it's got the potential, that US dollar index, 96, 97, probably got the chance to take a 98 handle out. So it's in an upward trend, and I think it's going to possibly be that, that sort of number by June or July. So I think it's going to edge higher from here.
Peter, I like how you cut straight to the meat of the matter. In terms of the number of Fed speakers that we have and the kind of U-turns we've seen from the Fed in the last 2 to 3 months, is the Fed talking too much?
I don't think so. I think the world's changed tremendously in those last 3 or 4 months. If you put your mind back to, August or, well, really July and August last year, then we saw that massive sell-off come towards the latter part of September. It really started to ratchet down. You saw energy markets get hit to the downside. You saw what's happening as far as base metals, all of those points. And then you saw, again, that Chinese market really get hammered. That put fear into the market, and like any Fed member, they're all human. They all understand, the demand picture. They're understanding what's going on from those, not only the man in the street, the woman in the street. They read newspapers, they listen to Bloomberg, and they understand what the headline numbers are. The fear of Brexit, the uncertainty there is being paramount, and that really creates turbulence and volatility, and that really needs to be settled. Theresa May, she's going to Brussels. All of these impacts have greatly affected and create volatility. And the Fed doesn't want volatility. They want a good, straight picture over the next matter of months. And that's an unknown at the moment with President Trump.
Peter, how do you strike the right balance between stocks and bonds in the United States at the moment? You listen to all the earnings revision and all the negativity around what could happen with a potential recession, and you look at the kind of yields you're getting on your 10-year paper, and you ask yourself the question, is it even worth the risk to go into equities?
Well, yeah, but, I think it is worth the risk. And I think it's worth the risk for a number of reasons. But more importantly, there's so much momentum and so much capital out there. They're looking for a new home, those dollars, and like anything, people are looking for opportunity, and traders are after maybe short-term investing. They're looking for a longer period. Retail is a big marketplace, a retail investor, and they look for markets that move. So they may go from FX this afternoon to gold this evening and then buy some US equities overnight. So we need to be very mindful of that across the global frontier, that there's more than just the large commercial buyers. There's also the retail sector, and they look for opportunity constantly from dividends and, of course, from growth sectors. And that's why I feel as though that there's more upside there for that US market.
Let's briefly get your thoughts as well on the European Central Bank, because they're in a bit of a quagmire. One of the governing, or the governing council member, Francois Villeroy, talking about how the slowdown of the European economy is, quote, significant and could change its interest rate guidance. What we've heard in the from the ECB in the past was there wouldn't be any movement until at least the summer. Is that likely to change, given the reality of the European economy?
I don't necessarily think it will. They've got to really ride this out. You know, what happens as far as, again, the Brussels issues with Brexit, how that, and they've got to get a couple of good months ahead of them. This last couple of months have been very bleak over there, and you need to get a little bit of sunshine. The autumn's nearly here. All of a sudden, you start to get into that June or July, that European summer, and there could be some good news coming there as far as, you know, a little bit further growth or whatever. So, again, we're sitting back at the moment. The central bankers are also realising what's happening with the Fed, and it could just be, you know, who moves first sort of thing. If the Fed pull back and they only do one rate rise, and that's the speculation, they may do none, then that's really going to put additional pressure, I think, on the euro and, you know, what happens as far as their ECB bank.
Peter, great catching up. Thank you for stopping by. That's Peter McGuire. He's the CEO of XM Australia.